Hi, what I'll do now is to talk about the actual calculation of the tax expense and the taxes payable. The recognition of current tax payable, receivable, is addressed in paragraph 12, where it tells us that current tax for current and prior periods shall, to the extent that it's unpaid, be recognised as a liability. So it meets the normal approach to thinking about a liability. With respect to non-current tax obligations, arrangements, this is addressed in paragraph 12, where it tells us that a deferred tax liability should be recognised for all taxable temporary differences, with some exceptions. And these taxable temporary differences are where you've been able to delay the payment of tax. The converse applies for deferred tax assets, and it tells you that where you've had to pay tax and you get a tax deduction later on, that creates a deductible temporary difference, and in those circumstances you recognise a deferred tax asset. You're also able to recognise a deferred tax asset where you have tax losses which are unused and can be carried forward. In terms of how you measure it, the current tax liability is measured at the amount that you expect to pay the tax authorities using the tax rate currently applying, using the legislation that is in place today. Non-current tax amounts, be they either tax liabilities or tax assets, these are calculated as the amount that you expect to pay based on the tax rates that have been enacted or have substantively enacted at the end of the reporting period. So quite obviously, if we have a reduction in the tax rate, then that's going to reduce the amount of tax that you have to pay, and that will reduce a deferred tax liability or asset. So it's adjusted to reflect changes in the tax rate. There is one thing which is unusual about deferred tax assets and deferred tax liabilities, and that is that there's no requirement to discount them. This is probably a pragmatic accommodation, because whilst discussing deferred tax assets and deferred tax liabilities in the standard seems relatively straightforward, in practice it is remarkably complex, and adding discounting to that would have made it increasingly problematic, so that's probably why the standard setters didn't go there. Quite obviously, if you have deferred tax assets, this is going to be subject to some type of limitation on the asset or an impairment test, and this is addressed in paragraph 56, whereby you can only carry forward deferred tax assets to the extent that they're going to be recovered. The tax expense should be generally recognised in the statement of profit or loss, and it should address both current and deferred taxes. However, there are some exceptions. So for example, if you have an asset revaluation, that gain is recognised in OCI. So quite obviously the tax associated with that gain would also be recognised in OCI. So you have a matching up of the accounting transaction and the tax consequences of the transaction. So you can see that quite clearly set out initially in paragraph 58, where it generally goes through the profit or loss, and in paragraph 61A, where that if it goes through somewhere else, it gets matched up there. There are circumstances where you can offset deferred tax assets and tax liabilities, or current taxes payable and current tax benefits, and you can only do so if there are legally enforceable rights to set off. So quite obviously you can't offset the tax payable in Australia with the tax refundable in another country, and it is expected that the tax be settled on a net basis. That's pretty standard.